My talk tonight is going to be about, we all exit one way or the other, and a lot of it is determined by the decisions you make in the beginning and as you go along the way, although there's a lot of it that you can't control. So, my background is I started a dating site in Dallas in 1995, which was almost as toxic as you could get. There was no money in Dallas for internet startups. I would tell people, what am I working on, and they would almost physically back up from me in case they were going to get contaminated. We ran that business, though, for 5 years, and we did have a successful exit for $47.5 million after only raising $90,000. And then to do it even harder, I helped my brother and sister, who were a big part of One and Only, start their own internet company. Again, we only put in $100,000, and they successfully exited this December, actually, which is one of my more prouder moments that they were able to follow in the path. So, getting out initially is just trying not to leave this way. So when you first start a company, your biggest concern is, will my exit be by going under? And so a lot of this won't be relevant in the initial stage because it's just a fight for survival. And you'll make sacrifices of your time and your effort, all just in an effort not to exit, the negative way. But then, if you do find product market fit and you have a successful business that's generating revenue, then you start to have a series of different decisions to make. And those decisions have really profound consequences. And there's a lot of pressure sometimes to raise money as a sign of being successful, or, this has been really hard, it's taken a long time, and if I just raise money, then I could get there sooner. But, it can have really profound consequences. So there were actually 2 dating sites. There was a brand, Match.com, that was started by Gary Kremen in San Francisco. And he raised $10 million right off the bat from a brand, a well-known venture capitalist. And they were 1 year ahead of us. And so we're in Dallas, and so it wasn't even really a choice. We just couldn't raise money. And we only raised $90,000 a year later. But if you roll forward at the end of the tape, Gary Kremen and the original team were fired by the venture capitalist. They ran out of money, and the VC sold them off, and he actually personally only made $40,000 from Match.com. And the whole time, it would have been very deceptive, looking from the outside. It looked like they were very successful. They'd raised the money. They were on all the magazine covers. But because they raised the money, they lost control of certain key decisions and ended up actually making nothing from the startup. And that's actually a lot more common than you would think. I run into a lot of founders who've had, on paper, a successful exit, and they really end up with, $200,000-$300,000. So the way I like to think about it is, once you're past survival mode, although I did it before we figured out the business model, you really have to decide, why am I building this? Am I building this to be famous? Am I building this to make a difference in a certain segment in society? Am I building it to have financial security? And you and the founding team need to really come into agreement of why you're doing it, because there's many reasons you could build a startup. All of them are totally valid. But if you don't know what outcome you're personally trying to get out of it, then it's very hard to know when it's time to get off the merry-go-round. So, the way to think about it is you have to look at, if it's a financial outcome, what milestones am I going to have to hit with this company to get the financial outcome that I want? And usually there's a lot of data. It's going to vary by market. You know, what you would have to do in San Francisco in the middle of this frenzy would be a lot less than you're going to have to do down here in Brazil. But you go out and there are databases of exits, and you take a look at it. And usually it's a multiple of some KPI in your business. And you can take that multiple and go, well, okay, if, you know, for dating, we had to get to 15 million in revenue to have a sellable asset. And you just kind of worked it backwards. Well, to get to 15 million, if the average person gives us $45, well, how many customers am I going to have? And to get that many customers, how much traffic am I going to have to get? How we just worked the equation backwards to see how far were we going to have to pull this thing to get the outcome that we set, you know, at the beginning. And then, you know, what resources am I going to need to get there? Do I need a certain amount of marketing dollars? Is it going to be, you know, in Match's case, the original Match, they went for a national branding strategy, but they only had $10 million, and it takes about $100 million to pull that off. And when it came time to raise the next round of money, they weren't able to do it. And so they were completely unsuccessful from a financial point of view because they didn't have the resources lined up to execute the strategy that they were pursuing. And, you know, the biggest thing I can say is learn your unit economics. You know, so every business has a basic economic of how you generate value. And it generally revolves around, I have to do something for the customer, and in return, they're going to give me this much money, and based on my overhead, here's what's left over. Now, I was fortunate in that for the personals business, it was insanely profitable. So it really was just a matter of finding marketing channels to drive traffic to the website, but a lot of other businesses have, you know, 10% margins, 20% margins. And you've got to know those numbers really well, almost intuitively, so that you can understand, well, how much money is left over to grow the company, to get to where I want to be, and what does that timeline look like? Oh, too far. So the other thing that I would say that you should be painfully aware of is that there are gaps in exit opportunities. So, you know, if you're an acqui-hire, then that implies that you're going to get, you know, a $2 to $5 million valuation. They're really looking to hire the team that you created. But if you're going to go and be a sellable really standalone, then that valuation might jump to 40 million. And in between, there's really not a lot of buyers. And this especially is true depending on who the acquirers could be. If you look at the acquirers, they have a natural pattern of how much they pay to buy outside companies. Ticketmaster City Search will buy other personal sites at about $40 to $60 million. They buy one every 2 to 3 years. And so if you were starting an online dating site and your valuation got up above 70 million, Ticketmaster City Search is no longer a viable company to exit. But the gap between that and being an independent public company is huge. So once you pass that gap, you're really saying, I have to go the full distance to get all the way to an IPO. And so just be aware that, you know, there's natural break points of selling, and if your outcome is at point A, don't blow by it because it may be a long way until you get to the next exit opportunity. The other thing is, you know, there's a statistical probability to different outcomes. This is a graph of the exit values of all companies that raised their money in the U.S. since 2007. And if you notice, there's a lot of dots in between 10 million and let's say 150 million. But if you're going to sell above that at $1 billion, it starts to get pretty thin air up there. And so I'm sure there's a very similar graph for Brazil. And the exit's down here. And it's going to have some sort of distribution. And the relevance of this really comes down to your fundraising strategy. So if you raise too much money and your exit is probably only going to be 20 million and you raise 10 million, I can almost guarantee you that were you to even get to the $20 million exit, all the rewards will go to the person who put the money in. I met a gentleman down at South by Southwest this year. He had recently sold his company for $75 million. He personally made $300,000. He had raised $25 million and took 6 years to get to an exit. And by the time he got to that exit, nothing was left over for the founding team. And this really is fairly common. And he would have been better off not raising the money and selling it for $5 million and getting all of it. And so you just have to think through, there's a probability of the exit, and raising money doesn't really change that probability. So it just raises the bar, and the person putting the money in, and I'm the same way, is okay with a failure, because as long as they have some of the companies that go all the way, then the ROI works out in the end, but it doesn't work out very well for the person starting the company. So, this is the part where you start raising money and bringing on partners. And this profoundly changes the math of the exit. Until you raise money, it's anything, once you get to break even and you're solvent and you're bringing money in the door, then it's really it's up to you, like you're the master of your own fate. And I'm not saying don't raise money, I'm just saying understand the consequences of it and be comfortable with it. So the biggest question to ask yourself is, what does the person giving me the money need to happen for this to be a win? And whatever that is, you're kind of locked in to doing that because you took their money. And they're going to push you and give you advice all geared toward them getting that outcome. And that's okay. I mean, that's perfectly acceptable, but just be aware that their outcome may not be your outcome. And the biggest consequence is that a lot of times in the contract, they will be able to veto you exiting below a certain valuation, even if that's the only viable way out. They would prefer that it go to zero than you to seek an early exit. And that's, like I said, again, that's totally fine. Just be aware that that's a trade-off you're making and get comfortable with it. And, you're naturally going to have to get bigger to get the same outcome. And a lot of it comes down to really tiny print around, 2x preferences, or just really understand what you're getting into, because they're going to get, even with these fantastic valuations that you're seeing in the Valley where someone's raising $200 million at, $15 billion valuation. In the tiny print, it says if the company sold for less than this, we get 4 times the money we put in, which could really change the whole thing. I mean, it can wipe out all the upside for the original shareholders. So this is an amazing number, and this is something that's really sobering. 75% of all entrepreneurs who raise a Series A receive absolutely nothing from their startup. So statistically, it's just, you thinking, wow, I made it to Series A, this thing's going to go right, everything's going to be great. And I talked to a lot of people that experience this number. And it's really powerful. And you just, again, know the risk that you're going in. I mean, when we went to sell our company, we also simultaneously had an offer from a venture capitalist for $7.5 million, or we could sell to Ticketmaster City Search for $47.5 million. And we sat down and, we looked at it really long and hard, and if you looked at what we were committing to, if we took that money, we were committing to try to go all the way to an IPO. And we just didn't feel like, it's 2000, the market's overblown, or do we take this huge pile of money and then like that? And so it was tough, but you have to go into it with all eyes open. So the other thing is not to get too concerned about how long it's going to take you. I always felt this tremendous pressure, another company would raise a lot of money and we'd be like, oh my God, they raised all this money, how are we going to compete? And what I found out over time was most of those people didn't figure out the market, or they didn't find the right product market fit, and they just fell by the wayside. And so if your real competition are not the other people, it's your ability to satisfy your customers. And if you stay focused on side and you stay focused on providing value to the people actually paying you, the outside noise doesn't really matter. So the biggest thing that you can't control, and this will drive you absolutely crazy, is the external market valuation. And you guys have gone through, a huge change in currency. I mean, it's gone in half, right? And that's no one's fault. I mean, you didn't do anything, your business didn't change, you're providing the same service. And so the thing that I've learned from being in in this tech startup world for 20 years is that this is the thing to really pay attention to. And where you pay attention to it is that when everyone gets super optimistic and multiples are really high, you might think about getting out, because that can change at the drop of a hat, and you can go from 8x and you're set for the rest of your life to 1x, and you're like, why the hell did I take all this risk and do this thing? And so my advice would be, we know that this stuff is cyclical. When it gets good, recognize that it's good and get out while it's good. And, we did that. We sold at the end of 1999. I got my last amount of stock, and it was $34 when we closed the deal. I put a collar on it, and it was 1 nickel above the collar at $10 when we got the last amount of money, and that's how much the world had changed in 4 months. And I can't tell you how many entrepreneurs I saw get totally wiped out in 2000, and I think we're going to experience something similar. I don't know when the market will turn in the U.S. When it does, you'll wonder where all the good times were, because it's going to be horrendous. And the problem is when you're young, you feel like, well, this is just the way it's supposed to be. It's supposed to be this good. And from going through the turmoil down here, things happen. And so just pay attention to multiples in terms of, if it gets super high, consider exiting and starting the next thing. That the last advice, one of the things I can say is that if you don't like the multiples, change the game or play a different game. So, if in the local market you're getting terrible multiples for revenue and profits, look at other markets. Or find a different segment that has better multiples. This is something that you can control. It's hard to change once you're 4 or 5 years in, but it's definitely something that you can change and you ought to take a look at, because the multiple has a huge impact on how much the 4 or 5 or 10 years of work is going to be worth. Questions? Yeah.
Hello.
Hi.
I was thinking here during your presentation about valuation of the companies in the early stage. So we have a company, and our case is that we have a lot of experience in venture capital, But sometimes we're thinking about if we are delivering all this value that we are presenting in the valuation, and we're already it's all the money. So my question was, it's okay to have a bigger valuation than the value of the company. How can this affect in the future of the company and etc.?
Well, you're talking about where you raise money ahead of where your underlying is. The problem is and it's tempting, right? Because it's like, wow, we're getting this great valuation. But if you have a down round, I mean, I went through this with a company that we had invested in. It can be devastating. It'll wipe out all the common shareholders, the whole thing. And I would strongly advise not getting too far ahead of your fundamentals. Because again, now if you're insanely profitable, it won't matter. Because then you can ride out any sort of market correction, but if you're depending on being able to raise money 6 months from now, a year from now, and you're worried that it's frothy and you're going to raise, it's extremely, it's risky, it can work, but it definitely increases the risk in the next round, and that a lot of things have to go right for you to be able to even raise it or raise it in a way that doesn't crush everybody that's in the company.
Mais perguntas? Ali, as pessoas estão com medo de levantar a mão agora, achando que não pode. Pode. Temos mais duas, tá? Vamos lá.
Hi, I'm an analyst of a venture capital firm. And I want to comment something with you. We don't have a very good database of multiples here in Brazil, so it's very hard to do these valuations.
Yes.
And I want you to comment when you don't have an industry, or if you have a startup that's extremely disruptive in the market, how you could do this valuation when you don't have any peer? Like, for example, if you have a very disruptive thing of a marketplace or other technology, you like compare with another company that's have a similar business model, or you're gonna go to another sector that have the same dynamics? How you see this?
I think my approach, are you early stage or later stage?
Early stage.
Early stage. So that's the area that I'm most familiar with. And the way people tend to seem to do it in the Valley is that they go, well, what if this does totally disrupt this business? What would that be worth? How big would that be? How is this a $10 billion company? Is it a $100 billion company? And if it's really that big and that disruptive, then the early valuation, while it's important, is not, because it's going to be one of those things that either succeeds massively or is a smoking hole in the ground. And so, whether you paid it $6 million or $7 million, I think anyone that put money in Uber, of course, we don't know where Uber will end up, but at the current valuation, they look like they have a smile on their face the whole time. The ones at least I've ran into. And so I think it's more of, if it succeeds, is this really big? And therefore, I'm comfortable that my return will be adequate regardless of if it's 6, 4. Because ultimately, if you're talking 6, 4, 5, 7, 8, you're sort of just moving chairs around on the deck. And it's more of, is it a $100 million company? Is it a $1 billion company? Is it a $10 billion company? And if it's only going to be a $20 to $100 million company, then you've got to really nail that valuation in order to get the ROI. And so that tends to be where I really focus more than 5, 6, or 7.
One more.
Hi, I wanted to know, do you see a lot of investors, like in Silicon Valley, interested in more in the return of the impact than the profit? I know that profit, it is important, but also, like, if you see a range of investors that want profit, but also genuinely want the impact that a startup is doing.
So are you talking social impact or
social
like,
or
holy crap, I'm going to change the world?
Yeah, maybe both.
Right?
Social and environmental.
I think, so when you're raising money, connecting emotionally with someone around the vision is the single most important thing you can do. Because I'm going to tell you, I mean, if I'm looking at 5 opportunities and one of them is going to change the way human beings interact on the planet, you're just going to be drawn to that. I mean, like I invested in this early stage company that's basically the Microsoft of synthetic DNA, and I went to this kitchen and we mixed up DNA and we injected it in a microbe. And I mean, I do want the ROI, but then there's a part of me that's just like, holy shit, this is the coolest thing I've ever seen. Like, I really want this to, you know, be the future. And so, as you're developing your story and you're connecting with investors, people want to do something, then they rationalize why they do it. And if you understand that, you will show them a future that they want to live in, and then they will rationalize why to give you the resources to get there.
Thank you.
Will Bunker, senhoras e senhores.
Thank you guys.
Thank you, Will.